Welcome to the GCV Weekly Briefing podcast, where we break down the key financial and economic developments shaping the landscape for investors, businesses, and policymakers. I'm Matthew, and this week we'll be diving into four major stories. From the rise of UK pension megafunds to the resilience of British businesses, the quiet creep of tax burdens, and a major blow to Trump's US tariffs. There's a lot to unpack, so let's get started. First up, let's take a look at UK pension reforms. The government has confirmed plans to consolidate various pension schemes into much larger, centralised megafunds. We're talking about combining assets from 86 local government pension scheme authorities and a range of defined contribution schemes. This could result in around 80 billion being redirected towards infrastructure and innovation-focused investments. The idea is to follow in the footsteps of countries like Canada and Australia. According to the Treasury, Canadian pension funds invest about 4 times more in infrastructure than UK counterparts. This consolidation is about catching up and competing. The government also wants these larger funds to boost domestic growth. That means setting local investment targets, directing capital into public services and regional economies. If it works, it could benefit savers as well as communities. But there's been some pushback. Some people in the pension industry have raised red flags about government overreach and the potential risks of investing such large sums into relatively illiquid assets. Despite the criticism, the government is pressing ahead with its new pension schemes bill. One key part of that will involve setting the maximum size for defined contribution schemes, encouraging smaller schemes to merge. The aim is to improve governance, reduce duplication, and give funds better bargaining power. Now, let's turn to UK businesses, because despite tough trading conditions and ongoing uncertainty, there's a surprising amount of resilience out there. A new survey of 1,000 businesses found that nearly half reported strong performance, and over half expected improved trade conditions within the next 2 years. Importantly, 76% say that pressure from trade tariffs and trade disruptions has actually pushed them to adapt and seek out new opportunities. And that adaptability is clear in the numbers. Let's have a look. 94% of businesses have adopted new technologies. 92% are entering and exploring new markets. 94% have made internal efficiency improvements. And 91% have launched new products or new services. That said, costs are rising, and around 70% of businesses say they've already seen an increase in operating expenses, and the majority expect that trend to continue. In response, over 70% are reassessing their long-term strategies. They're also diversifying. Most are expanding into more stable regions, forming strategic partnerships and reshoring opportunities to gain more control. Over 80% have diversified suppliers and started buffering inventory. Stephanie Bettant, head of Global Trade Solutions at HSBC UK, summed it up very well. Businesses are looking for greater clarity, but continue to show resilience and adaptability in the way that they operate. Many are even seeing the ongoing uncertainty as a catalyst for growth despite rising costs. Now, onto the dreaded topic of taxation. While we haven't seen any major headline increases in income tax rates, the reality is that the tax burden is rising, and it's affecting millions. The current freeze on the 45% additional rate threshold has already pulled more people into higher tax bands. But new analysts suggest that if this freeze stays in place until 2033, the number of people paying the top rate could go from just 1 million today to 8.6 million. That's roughly 1 in 6 earners. This type of fiscal drag, where inflation and wage growth push more people into higher tax brackets, is essentially a stealth tax. It raises revenue without changing the actual tax rates. Critics really aren't holding back. Jason Hollins of Evelyn Partners called it a slow, painful method of financial torture, and little more than a disguised tax rise. It's not just income tax though. Inheritance tax thresholds have been frozen since 2010, even as house prices have climbed. This means that more estates are being dragged into the 40% inheritance tax bracket, set to affect 10% of estates by 2030, which is up 4% from today. To the Chancellor's decision to make unspent pension wealth subject to inheritance tax from 2027. And we're seeing a broad-based increase in the effective tax burden, without any official tax raises. For many, that makes tax-efficient strategies more important than ever. Schemes like the EIS and SEIS remain key tools for managing long-term liabilities and preserving more of your returns. Finally, to the US, where a major court ruling has struck down a sweeping set of tariffs imposed during Donald Trump's presidency. The US Court of International Trade has ruled that Trump exceeded his legal authority when he introduced these broad range of tariffs on imports. The court made it very clear, only Congress has constitutional authority to regulate trade. The tariffs in question included a baseline 10% on most imports, with higher rates for goods just from countries like China, Mexico, and Canada. The court found that the national emergency used to justify these tariffs didn't quite meet the legal threshold. The economic impact of this is substantial. Trump had planned to use revenues from tariffs, projected to be between $200 billion and $600 billion a year, to fund tax cuts and spending. That is now off the table. Markets welcomed this decision. US stock futures rose and the dollar strengthened a little. There's a sense that this could ease trade tensions, though that optimism may be short-lived. The White House says it'll appeal the ruling and explore other legal routes to reinstate some of these tariffs. But the precedent is now set. The president's power to act unilaterally on trade has been significantly checked. Today's stories showcase a range of trends changing our investment landscape, from the quiet drag of frozen tax thresholds to the restructuring of pensions and legal pushback on executive trade powers in the US. Whilst the US news seems far away, small changes really do affect us greatly, both directly and indirectly. At the same time, the UK's progress in shifting pension capital towards more productive assets is positioning it as a leader in long-term infrastructure investment, despite challenges in cost pressures and tax policy. Be sure to stay tuned for next briefing, where we'll break down more developments coming our way. But for today, that's all. Thank you very much for listening.